Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is Tuesday, May 16th, and we have today Sam Burns and Ira Harris. Sam is the chief strategist at Mill Street Research. That's an independent research company specializing in proprietary institutional research tools for asset allocation, stock selection, and macroeconomic indicators. He's recently introduced a new Financial Insiders Report for individual investors, the weekly roundup, and he has more than 20 years of experience as a market strategist, providing U.S. and global investment insights at Wall Street firms, including Oppenheimer, Brown Brothers Harriman, State Street Global Markets, and Ned Davis Research. Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and also a stint most recently. Welcome, gentlemen.
Thank you.
Thank you.
Great. I thought we'd begin with a discussion, Sam, on your view, your macro view, global macro view on the economy and the financial markets.
Sure. No, it sounds good. And thanks for having me on. Yeah, I guess, what's been interesting in the last, I don't know, certainly, 3 to 6 months has been the level of negativity that I've heard from a lot of people, including some of my clients, about earnings and the economy, particularly in the US and Europe, but also China, and how, in the last, even the last few weeks of earnings season and the data that's come in has been, better than expected. Not that it's been great, just that it's been less bad than what a lot of people had anticipated. And I think that's why, equity markets have done better, and, credit markets are holding up. So I think it's been a setup of, things don't have to be good. They just have to be less bad than expected in order for markets to do better. And that's what we've seen lately. So I think, the overall kind of economic backdrop is one of slowing, but not stopping so far. I think, inflation is on its way down, has been for a while. I think the Fed is probably done, raising interest rates for now, and the ECB will probably be, along doing the same shortly. So I think most of the monetary tightening is probably past. So I think it's a question of now, fiscal policy will be very important, and I think the kind of the leftover lagged effects of COVID and the stimulus and the war in Europe are really the main drivers right now.
Interesting. And your thoughts, Ira?
Well, I agree with most things that Sam says. On Europe, I'm maybe a little bit different, only because they don't have the effective tool of quantitative tightening, because I think Lagarde rightfully is very worried about the fragmentation of the debt markets in Europe. So I think they're proceeding more cautiously, and therefore she has to buy the hawks off, quote unquote, the hawks. And we can call them the Hanseatic Five. We can, they go back a way. It's Austria, of course, Germany, the Dutch. There are a few others who would like, they really are battling inflation. Inflation's been higher in Europe, but they can't. It's very hard to shrink that balance sheet. I know they're talking 15. They're doing. We don't know that they're doing it, but they're talking 15 billion. And then what did she say at the last press conference? They would let the expiring debt that the ECB owns just roll down and not reinvest it. So we don't know about that yet. But I think I'm with Sam. I can't believe that the Fed has raised the last two anyway. I don't know. They said that they did it for the worst reason possible, which is both times that if they didn't, the market would interpret it to be something highly more negative. Well, that's a lousy way of setting. You're setting monetary policy. Don't worry about the markets. The markets, the Fed's just afraid to let them adjust, and they have been since the great Bernanke tantrum when he reacted to the taper tantrum, and then of course the Powell pivot. Let the markets react, and if they get punished and drop 10 or 15%, so be it. You'll be healthier. But I totally agree with Sam's view. Outside of what I think the ECB's hands are just more tied until they get their next crisis anyway.
And what are your thoughts in regard to the upcoming debt ceiling, challenges? Do you see any rough patches there in terms of monetary policy, or how is it going to play out in the financial markets, like interest rates, monetary policy, effects on the commodities and the equity markets?
Yeah, I think it's definitely going to have a short-term impact. I think a lot of the markets are still expecting a deal to be worked out of some kind, just because that's tended to be what's happened, even if it's at the last minute. But I think it is a worry from a kind of a fiscal policy standpoint, if it involves a government shutdown, perhaps for a while, or other things that interrupt the normal flow of fiscal policy, essentially, even temporarily. That's another thing that could potentially weaken the economy. I think the Fed is more focused on the banking system and credit right now than the debt ceiling. But I think just because those are things that are more in its wheelhouse, but also things that have been going on for a while and are a little bit more of a a structural issue that the Fed has something to do with. I think the equity markets and credit markets and things are still kind of in a wait and see mode, but it just kind of reveals more dysfunction in the government. And that the fiscal policy that's been relatively supportive for the U.S. for a while now is looking like it's going to be going the other way over the next, say, year or two, now that the Congress is split. So I think it's a self-inflicted wound. Of course, it's a politically generated crisis. It's not a real thing, but it is going to probably distort things for at least for a little while. And because now the Treasury general account has been run down and will have to be refilled, there's a lot of short-term liquidity issues that'll probably have an impact over the next few months as things adjust, assuming they do come to some sort of a deal. But I think it's one of those things. It's a manufactured crisis, so it's a question of whether the politics will work out. It's a very weird political situation right now, even compared to past debt ceiling, debates. So it's hard to predict how exactly it's going to work out this time.
Mm-hmm. And your thoughts on that?
When Sam says self-inflicted, I look at the FT headlines this morning, and it's Yellen saying rates are going to go higher. But let me tell you what, Yellen really began this when she all of a sudden invoked June 1st, and all you did was see the 1-month T-bill rate, which that was kind of inverted because the shorter durations were down to 3.5, 3.3, in anticipation that we weren't going to hit this issue until late July or early August. So that part of the T-bill curve was had a much higher yield. Now, I bought a 1-month T-bill two weeks ago for 5.8 right after Janet talked. So, thank you, but you keep bringing this up and you keep pushing the immediate rates higher because it creates some uncertainty, especially for the money funds who need to be paid. I don't need to be paid. As Bill Gross rightfully said, I don't need to be paid. I can wait because I don't think the United States is going to. They might be in technical default, but they're not defaulting on their debts. So, if you have flexibility like I do, you can do that. But this is all self-inflicted. For the life of me, we play this game, and we allowed ourselves to be held hostage. And so I think Sam's 100% right on that.
Mm-hmm. What are your thoughts, Sam, on the U.S. yield curve? Like, why do you think the 1 month is very high and actually rapidly increasing, or has been? Any thoughts also on the yield curve spread trends, like 2 10s, 530s, or any thoughts there?
Yeah, no, I think, I was right that the very short term, the 1 month, 2 month, kind of that very short end of the yield curve is being distorted because there's some fund managers who probably don't want to be shown to own those particular instruments around the time that there might be some sort of a delay in payments, or something that looks like a technical default briefly. There are certainly fund managers out there who are going to feel pressure not to own those things, and that's what I think they've been avoiding them, and that's why you have that kind of skew in the very short term end of the yield curve. But I think the overall yield curve, of course, has been heavily inverted for a long time, just because I think the market sees inflation coming down more than the Fed is at least publicly stating, and assuming that the Fed will not be able to hold rates up at 5% for very long, just because the overall economy probably doesn't warrant that. And that if you look at 5% Fed funds rate relative to 2.5% expected inflation rate, what the market's pricing in the next couple of years, that's already pretty tight. And when you look at what commodity prices are doing, what even housing prices are doing, and what a lot of the data is showing, inflation is not going to be the issue 6 months from now, and 5% is going to look pretty high once the data really kind of adjusts. So I think that's what the market's pricing in. I think that a 3.5% 10-year yield shows you where people assume the rates are going to kind of get back towards. And even the Fed says that 2.5% is probably the long run steady state rate for short-term interest rates, and so 5 is a way above that. And so it's a question of, well, at what point do they start moving back in that direction, assuming no more big global shocks? We don't have another pandemic or a war in Europe or something like that. But I think overall the shocks we've had are fading in terms of supply chains and in terms of stimulus demand, all that kind of thing we've had the last 3 years. And so the reverting back to probably closer to pre-COVID, low inflation, low growth kind of environment, the demographics, the level of debt, technology, all those things point in the direction of lower inflation, not higher. And I think that's where we'll get to eventually. It's just a question of the path we take to get there.
Mm-hmm. Interesting. Your thoughts, Ira?
Well, these are the big topics, and I'm glad we're talking about them, because every day I scratch my head and I go, okay, I agree with it, and I see this, and I go, but I still look at myself. I go, why would I? Who is buying long-term U.S. duration? I think the uncertainties that the U.S. faces, regardless, rates could come down to 3% tomorrow. On the short end, where does the 10-year go to 2%? I know that Zuoff and others were out there talking about it, and people I have great respect for. I don't know, how Sam views them, but when I think about David Rosenberg and Lacey Hunt, I mean, these are giants in the industry, and they're not giants just because they make headlines. They're giants because their thoughts have been pretty good over 40 years. So they have a long sustained history. Doesn't always make you right, but I still can't wrap myself around. In fact, I was having a long conversation last night with somebody I've known since grammar school and high school, but who's runs the think tank in Washington. We were talking about it. I just don't see where this goes. The structural problems building, and those problems, now everybody, Richard, we've done a lot of podcasts, and I always cite my good friend Kevin McCarthy, not the one from Congress, but one I went to graduate school with. And we've talked about this for the last 2 years. What's going to happen when the Fed starts raising rates and the cost of financing the huge U.S. deficit? Now, people tell me deficits don't matter, but that financing, you run into the political problems once the cost of that debt exceeds the defense budget. You've gone to a really dangerous line, and everybody says to Powell, oh, find your inner Volcker. And as I've maintained, when Volcker was Volcker, the debt to GDP ratio in the US was 39%. And the amount of private debt outside of mortgage was nowhere near, because first of all, that was at the beginning of the credit card. And I know, because I got my first credit card when I had to for work, an American Express card in 1980. I mean, my family never had a credit card. It was unheard of. I I grew up with the mantra, okay, you can borrow for a house, but if you don't need, you're not going to borrow to buy a television. You're not going to borrow, yes, if you need a car to get around, yeah, but you don't borrow just to borrow. And we're in a whole different world that we face today with that. Nobody more than the federal government could Volcker, with this kind of, let's say that conservatively, let's use the 100% number of the debt to could Volcker raise rates? There's not a chance in the world. He would have been under, he had great duress from a lot of people, the real estate people, the farmers. And I remember it because I was working in Chicago in the LaSalle Street and saw those tractors show up, so those were real concerns, and it concerns me. So this is, to me, a great jumping off point, because where are we going from here? Forget about the debt ceiling. That will be resolved whether we like the outcomes or not. But where do we jump after that? Because we do have a structural issue now with the amount of debt.
Any thoughts on that, Sam, in terms of effects on, especially like the US dollar? Will that be sacrificed to keep everything, stable? Do you see the de-dollarization trend that's being talked about today?
Yeah, I think, the rise in higher interest rates, certainly make, carrying debt more expensive for those of us who are in the private sector, but also, for the government. I'm less worried about the government side of things, and also because I don't think that rates are going to stay where they are. I think that we can probably manage paying 3 or 4% on treasuries without the government, the federal government, having a problem with that. As far as the dollar, I think that as the rate differentials globally have narrowed, meaning the U.S. is no longer way higher than all the other countries. They've kind of caught up now. I think that's why the dollar has kind of weakened or at least been more stable lately. I don't really see de-dollarization overall as an issue, just because I don't know what the alternative to the dollar is still. If you for real size, major money, where are you going to go? The euro is not stable enough for most people. It would be the only other real large enough currency. Everything else is too small to be a global currency. And so I think that again, maybe it's the best house in a bad neighborhood kind of a thing, but the U.S. is still the strongest place to put money globally. And so I think I don't think the dollar itself is going to fall apart. I think that the strength we had in 2021 and 2022, the people were actually complaining about because it was too strong. That's gone away and probably won't come back for a while. But I don't see the dollar itself being an issue as much as if the Fed is over tightened, what does that mean for the global economic picture? And will they kind of be able to adapt to that? But I think that they're trying to keep their inflation fighting credibility, which they kind of have wobbled a bit on. And I think that's partly why the last few hikes they've done, because for a while they were complaining that if they didn't hike, or if they didn't keep a hawkish view, the markets would go up too much, that they would loosen financial conditions, bond yields would go down, stocks would go up, and that would offset what they were trying to do to fight inflation. And now it's maybe the other way of, well, maybe they've tightened a little too much and the banks are struggling, and credit growth is slowing down a lot, and maybe we got to pause and wait and see what the effects of that have been. So even the Fed's messaging has shifted over the last few months, and the way the markets interpret the economic data. It used to be strong data was bad because it meant the Fed was going to tighten and too much inflation. Now it's gone, well, growth has slowed down, and we're not worried about inflation anymore, and we actually, good news, maybe good news. If you're expecting a recession, then stronger data looks better and helps things like the dollar. So I think even the interpretation of where you are in the cycle has shifted just in the last 6 months, and probably will continue to do so over the next few months. But I don't see the federal government deficit being an issue structurally as much as it does for the private sector. Whether credit card rates and mortgage rates and those kind of things are what's going to be the problem, more so than the federal side.
Mm-hmm. Interesting. Your thoughts, Sarah?
Well, this is where we're at. So I don't know. The government debt does. I'm in a little different view there, because I think it is going to be an issue just as the budgetary, just as our whole budgeting process. But if I push that aside, I was in the camp very vocally on this podcast many times, talking about when the dollar ran up, using the dollar index up to 112, 113, the euro was pushing down at par. Well, the yen was sitting in here. So, and I thought it was really strangling the global economy, only again, because the overhang of dollar denominated debt was so huge. And it wasn't just that the Fed was raising rates, it's that the dollar was going higher, and you had all these dollar funded liabilities that had to be paid with a rising dollar. And then we saw something that we've never seen, which was that the emerging market was actually racing ahead and actually preempting the Fed. We had Mexico, we had Brazil, we had more and more South Korea. They were raising because they didn't want their currencies weakened, because they knew that the dollar overhang. So you were really creating that feedback loop of, well, the Fed's going, we have to go, the Fed's go. So conditions were tightening in a global sense. Yes, and taking other, and we saw with the equity markets. Now, I agree with Sam on the tightening financial conditions. The Fed gets locked into looking at the equity market. I think the equity market is a proverbial straw man in this environment, because it's a recipient. As Rick Santelli and I were talking last week, it's like the Bank of Japan needs to change course, because the Japanese send all kinds of money all over the world as long as they sustain that policy of yield curve control, and they keep that currency, I think, artificially low. And I mean, I'm watching it as we speak. That euro yen, which I think is a much more important barometer of the global trade, especially because the Japanese and Germans compete so directly in so many markets: automobiles, machine tools, optical. I mean, we can go on and on. It's a massive competition, and the yen is very weak on a relative basis to the euro, especially. And I think that creates a problem, because it sends Japanese investors sending money all over the world, which is why they need to stop looking at equity markets, because I think the equity markets become receptacles for a lot of the money that's still flowing. Money it's tightened in some, but not as an investable good all over the world, not as much as the Fed would like to think. And I think, we're at the G7 as when we were getting ready for the podcast. I think they need to discuss that, because it makes their job, and then makes everybody else's job. Because if the Fed is only going to look at the equity market, then they're chasing themselves, because the equities don't break because money's available and real yields are okay. I'm not sure where real yields. Powell at his last press conference said real yield, if he goes out 1 year, the inflation expectations are 3%, and with a 5% overnight, well, that's looking out. So if I buy a 2-year note at 4%, I'm effectively getting a 1% real yield. Well, those types of real yields should stem the growth in the equity markets, at least for a period, because we haven't seen those types of real yields. So it gets us into this real bind, and you have to look globally. The domestic situation is not going to give you the answer. That's just my opinion.
Mm-hmm. Any thoughts on Japan, Sam, in terms of like the Japanese currency or yield curve control there, inflation trends in Japan?
Yeah, Japan has been an interesting market for a while. Excuse me, just because they have had that full control over the yield curve, and basically the Bank of Japan has taken over the government bond market there, and to some degree even the equity market. They're a lot more involved in their equity market than certainly than we are, or other most European countries. So I think and in fact they have a new central bank governor coming in who might decide to change things eventually. But they've had their first real inflation for many years, and it's unclear what to do about that. They were fighting so hard to get inflation for a while, and now they've got some of it. The question is, what do you do about that? but the fact that they do still have a relatively, more controlled, kind of closed economy, at least in terms of their government debt, means that they can, manage things how they choose to some degree, and are still considered a very, stable currency. So it'll be interesting to see if they decide that they need to allow their interest rates to rise even mildly. There was a lot of debate about that a little while ago, of letting their 10-year yield go up to 0.5% or something like that. Was considered a big deal. So I think it's potentially a shift in the way they're thinking about their policy after however many years it's been of basically just sitting at zero and hoping that that the economy will sort of hold up. That they've provided as much stimulus, both fiscal and monetary stimulus, as they can, but the demographics and everything else are very much in a declining kind of deflationary trend, and it's hard to fight that. And the same is getting to be the case for China, which of course is much bigger, and that they're facing demographics turning the other way. They have a lot of debt and real estate issues, and I think that's affecting the whole kind of Asian side of the global economy more so than say in the U.S. and Europe. So I think you're definitely seeing more divergences now, where the inflation problem is mostly in sort of the West and less so in the East, but it is picking up in Japan and is making people think about the Japanese currency and whether the new leadership is going to change things or not. And I don't know.
Mm-hmm. Yeah, I mean, speaking of dichotomy, do you see a divergence as well, like globally, in terms of the indebted G7, the West, versus like what's being termed the global South or the BRICS countries? Because the data seems to indicate that there's not really much recession going on in the yellow crescent, type of countries versus the G7 countries. Any thoughts there?
Yeah, no, you're right. I think some of the emerging markets and kind of global South countries, have held up. Some of them are commodity tied, some are not. And I think, as Ira was saying, the ones that have a lot of dollar-denominated debt, have to worry about their currencies, just because they can't afford to have a balanced payments crisis. But there's a lot of divergences even within those markets. In terms of the politics and the structural issues they face. Certainly Russia has basically disappeared from that group. They don't have an equity market anymore, and they're kind of falling apart. Whereas Brazil has inflation issues and is has things to worry about, but is very different. China, of course, is the big driver of most emerging markets, certainly the Asian side, and that's been the weak part. I've been underweight emerging markets in terms of equities for a while, largely because of the weakness in China, whereas the emerging markets outside of China have generally tended to hold up better, at least on the indicators that I look at, which are more based on kind of the earnings estimate revisions trends and things like that, the corporate fundamentals for a lot of the emerging markets companies, more from a bottom-up standpoint. But I think it varies wildly depending on which countries you're talking about and who's running them. As opposed in terms of the risks that they face and their currencies in particular. But I think everyone's kind of reacting to some degree to what the West and the Fed and ECB are doing in terms of policy, and trying to adjust to that. And then of course you've got places like Turkey, which have had huge inflation and and very unusual monetary policy, but that may be changing depending on the outcome of their election here shortly.
Mm-hmm. And your thoughts, Ira?
Oh, it's all things that I think are absolutely on the front burner. And then, again, Sam looks at it, I think the same way I do. Where are the investable opportunities coming out of there? And I think the Chinese situation has been very, very interesting. I mean, we saw, I think, retail sales out of there last night, which jumped dramatically, but a lot of that was in travel. I saw some of the breakdown of the number. It certainly didn't affect, didn't have a buy for as much growth as their copper took I think is down about 3% this morning, which when you would have seen a number like that would have been indicative of what's really going on. So the amount of uncertainty as we chase this, view around the world, and of course you throw in war and everything else that is always seems to be with us in one way or another, and threats about war. It is very difficult. I'm a little more positive on certain, and again, it's not a totality. So not all emerging markets are good, as Sam talks about. Some are better than others. Mexico has been a transformative story. To me, not a surprise, because as soon as Trump started talking about some of the things about, of course, the tariffs on China, Mexico became a more interesting story. And then, of course, you got AMLO elected, and hopefully that was going to have an impact in dealing with, Mexico's biggest problem to me is its corruption. It's just endemic corruption. Not that other systems, believe me, we can find corruption everywhere, but it's just so endemic in Mexico. And yet there's so much now investment going into Mexico that it's being able to overcome it. Yes, Mexican overnight rates are 11 and a quarter, which gives you a really nice real yield return on short-term deposits. But the real money, this was a story that everybody's been waiting for really 30 years. If we go back to when NAFTA came into being, January 1st, 1994. But of course, China stole his thunder because China depreciated the yuan 50% on January 1st, 1994. So the Chinese are always they know what's going on in the world, and they're trying to react and get ahead of it. But now we're starting to see that shift, right? Because it's just much easier to, if you're a U.S. Manufacturer, a U.S. anything, to have supply lines shortened to Mexico. Yes, the wages, although I would probably argue that with the currency depreciation over those 30 years, Mexico's become even a better story. So, and I think as Sam talks about, Brazil's a better story. Now, Brazil under Lula, we're going to find out, because Lula is looking for a bigger voice on the international scene. And China and Brazil are closer for rightful reasons. And again, what I say is not political, but the Trump tariffs, when Navarro went after the ag exports, putting tariffs on U.S. ag exports, the answer was simple. It was called Brazil. And this year we had a record crop, soybean crops, because I'll use that, of I think about 5.8 billion bushels. That's an enormous number. So China and Brazil have grown closer, which gives gives Brazil a bigger voice on the northern-southern divide, because they have to live with the Chinese. The Chinese, they provide what the Chinese will always need food, always. And food is not something the Chinese will ever play with, because hungry people have never been kind to the Chinese political edifice. So food is priority one. So that relationship, and we can't then just poke at the Brazilians and go, well, no, because they have their own interest. Everybody has their own interests. So I think Sam's point, and we have to scour and find out which ones are going to be the best to promote that.
And given all these events and trends, what are your thoughts for asset allocation, generic asset classes, sectors, regional exposure?
Yeah, no, I think there's going to be a lot of, probably shifts coming up in the next 6 to 12 months. What I've been, focused on recently has been that kind of idea of things are not as bad as expected. And that's had me more bullish on equities in general, and underweight fixed income, and certainly underweight the long end of the U.S. bond market. I think that's a reflection of both the earnings story has been better than expected, and fiscal policy has helped to offset the tightening of monetary policy, which is unusual. Most of the past cycles we've had the last 20, 30 years, both monetary and fiscal policy tend to tighten at the same time and then try to after the fact loosen at the same time. And in this case, we've had more supportive fiscal policy that's partly coming after COVID, but also some of the other infrastructure bills and things like that. Now that's probably going to fade away over the next couple of years, But for right now, we've still got a reasonably supportive fiscal policy in the US. And that's I think, helping offset kind of the effects of tighter monetary policy and helped, earnings and the overall economy hold up better than a lot of people expected. And particularly in Europe, I've actually been overweight European equities because I've seen that earnings estimates, for instance, have held up much better in Europe than they have in the US and are actually net positive. Their estimates were going up. Whereas, 6 months ago, everyone, almost to a person, expected a severe recession in Europe, that the energy crisis would destroy the whole economy and the earnings were going to collapse and everything was going to, fall apart. And again, Europe's not great, but it's not falling. It's not, going to zero. It's not, the economy has managed to avoid recession. They managed to get through last winter. They paid through the nose for energy, but they made it. And now they're managing to hold up. Their banking system is actually held up better than ours has lately, which is something I never thought I'd say. Certainly over the last 20 years, it's always been US banks are strong and European banks are weak, and certainly at least since 2008. But now it's kind of gone the other way a little bit, and so I think there's opportunities in places like Europe still, and certainly on a relative equity basis. That's where I've been most overweight. I've been favoring stocks over bonds for a while, and still am. I think there's still a lot of pessimism out there. And I think from an investor behavior kind of sentiment standpoint, it's harder to be real bearish when everybody else is already bearish. And I think there's a lot of these sort of climbing the wall of worry that we maybe still have to go before we see a peak. And if you think the Fed is done raising rates, if you think inflation is going to become less of a problem, but the economy might avoid recession, or at least a bad one, and corporate earnings can hold up, that's not a bad scenario to own equities. I've even been overweight some of the cyclical sectors like industrials or consumer discretionary, along with technology, as kind of, I think, growth has probably got more of a tailwind now over value in terms of style allocation because of interest rates and the slowing overall growth picture. But I think that some of the cyclical areas are, still have some tailwinds. A lot of industrial stocks and discretionary stocks look pretty good in my work, whereas the financials have been weaker. Energy certainly been weaker, even though they're cheap. And a lot of the defensives are kind of, particularly healthcare, are still struggling in my work. So I don't see a lot of support for the traditional defensives, and I do see some tailwinds still for some of the traditional cyclicals, which again is, maybe not what you would expect given, if you just kind of look at the big picture macro, or you hear people talk about, imminent recession, you wouldn't think of buying cyclicals or Europe. But I think they still can do pretty well and have lately.
Mm-hmm. Interesting. That's great insights. Ira, your thoughts?
Yeah, I'm laughing because when I hear Sam talk about, I've been buying
European.
For me, this was like
Yeah.
unbelievable that I actually bought some European financials.
Exactly.
I was looking at Commerzbank. I own UBS, but that's a different story. And because that was like Morgan Stanley. They were returning back to me, I saw as basics, and I saw that coming out of 2020, and they no longer wanted to be Goldman Sachs. And I see that you had worked at State Street, and State Street I know pretty well. So State Street found their own niche when they thought that they could be another Goldman Sachs. All these banks who believed that they were going to trade their way to great riches. It's not a model that's easy. So I've actually been, it's such a dog and for me to buy it. I don't own right now. I don't think I own one US bank. I've been out of them. But I've owned Commerzbank, and actually Commerzbank is now going to pay a dividend. And once I saw Jens Wiedmann go to Commerz, it's an interesting story. And I think that one of my things that I loved about Commerzbank was that Europe, which doesn't have a broker-dealer system for their bond market, is going to have to go to a broker-dealer system because they've got this enormous issue. And they'll probably try to build on the PEP bonds by creating the Euro bond, because I can synthetically put it together, but it's not easy. And when I read the ECB paper on it and EU, that it looked like if they go that way, you have to be domiciled in the EU, which, Paris isn't a bad place to live, and we can find, but that puts, banks like Commerz, who they've wondered what to do with for all these years anyway. I mean, the merger between Deutsche and Commerce has been tried probably since the launch of the euro, because the Germans, of course, were supposedly overbanked, but now it sits out there. I go, why aren't people looking at this? And they're actually paying a dividend. One of the things that detracted me was Cerebras owned about 10% of it, and I'm not a fan of the private equity model. They seem to be very self-serving, and I understand that, but it doesn't mean I have to like it. So although they did sell off some of it, so I'm laughing because for me to buy a European, I remember going back 6, 7, 8 years, and I washed my hands of Deutsche Bank once the price went through the 200-day moving average. I said, they're just, I think it was at 27.20. I took a small risk, but and I also like the Japanese banks, because to me, the Japanese equity market, and we've had long discussions. David Rosenberg and I had one just recently, and Buffett sees it too, because you got a weak currency, and he's been buying into those large Japanese trading houses since the onset of COVID, and he was very public about it. But the Japanese banks, which have done nothing, I've been in Tokyo Mitsubishi for 8 years, and it's been like owning a bond. It's been sideways, but the yield for the most part has been about 4% dividend. So you know what? Okay, yeah, they're not going anywhere. Hopefully they would go up, but I can't. They sit out there, and the fact that they own 22% of Morgan Stanley. So I've been, I'm in the same. It's interesting. Sam, you and I've never talked before, and I'm going to say, outside until Richard told me. So I went and scout, as I always do, go look a little bit to see what the research is that I can avail myself of. But it's interesting. I see very similar. And in the U.S. financials, they've got some things to work out here, quite a bit of things. So I've stayed away from the only place I bank is J.P. Morgan, because to me, that is the ultimate too big to fail. As a very good friend of mine back in the aughts told me that J.P. Morgan could never go under, just like Bank of New York, because they were the transit banks for the Fed. So everything would seize up. And State Street, as a fiduciary and custodial, I don't think they quite made it. They had that, but I speak to that because I know you're in Boston, and you said that you had, or Richard, talked about it. I knew a guy, John Moore, there very well, because I did a lot of foreign currency business in the 06, 07, 08. So I knew the group pretty well. So, they step back from that too. So yeah, I think State Street is one that I would eventually look at, but I'm very, very cautious on the U.S. financial system. I need to see, only again, because we saw it with Signature, we saw it with Silicon Valley, we saw it. First Republic was a darling of the world. I think that's a stock that went from $145 in February to zero. If that doesn't make you sit up and pay attention to the risk you face, because everybody for 30 years loved First Republic. They couldn't talk great enough about it. And look, and it wasn't even from problem loans. It was a portfolio that they had very complacently, you want to talk about Minsky, that was Minsky, because they had nowhere else to go. So, hey, yeah, I'll buy 3%, 3.5% MBS until I have to go sell them. And then I find out that the valuation is not nearly what I was carrying on my books. But I agree with you wholeheartedly. And one company, I don't know the way I'm seeing in Europe, one company that I've loved, it's starting to move a little bit now, but ABB, the large engineering consortium of Sweden, Switzerland. But once Ukraine gets rebuilt, and they have such a huge green footprint. So I don't know how you feel about ESG. I'm not a fan of it, but I'm an investor, and I have to be malleable enough to adjust to what I see out there.
Yeah, no, I agree that there's definitely some cyclical, plays in Europe that are worth looking at as well, and those are showing up in my work as well. Again, people assuming that Europe is a basket case and that there's no growth there. There are areas that are growing, and they have a different profile. They don't have nearly as much of the tech that we do in the U.S., but they have other areas that can benefit, from from either just, direct stimulus, or whether it's related to the, green type spending, or rebuilding Ukraine, or reorienting the whole energy system. There's a lot going on there that you could potentially benefit from, that a lot of people have kind of overlooked, I think, to some degree. But yeah, no, I would agree with that.
Well, great. It's been a great discussion, and just wondering how our listeners and viewers can learn more about your work, Sam, and also if you could give a link on how people can get the weekly roundup.
Sure. Yeah. No, my website is millstreetresearch.com, and it has a lot of sample reports that you can see. There's a blog that I update once in a while, so you can kind of get a feel for how I look at things. There's I post relatively often now on Twitter, the @millstreetresearch handle, kind of day-to-day commentary and examples of some of the work and the indicators that I follow. And then the weekly roundup. There's a link on the website where you can find it's $50 a month. It's a way to get kind of a slice of what I provide to the institutional clients who pay a lot more than that, to get stock ideas, macro asset allocation ideas, and some commentary on what Fed, inflation, commodity prices, the dollar, all those things that are going on that I'm seeing in my indicators. So it's a good way for people who want to get a taste of what I do, and then those that are managing money professionally potentially can reach out. There's a contact form on the website, and get in touch and see if they want to pursue more.
Awesome. Thanks. And Ira?
Well, I'm not, of course, write as much as I would like to with my blog, Notes from Underground, but I do so many of these podcasts now, thanks to you, Richard. So, I'm out there, and again, it gets me to be able to exchange ideas with Sam. So I think there's more value to, I keep promoting that, but people are so underserved because, yes, as Sam says, the institutionals pay, and rightfully so, because it's a good, they need to, family wealth offices, they need this, but lessers too, and I talk to friends of mine, who have, at retirement or in that, and are so underserved because, let's face it, you don't walk in to a bank like JP Morgan Wealth Management and get that type of service. So you need to avail yourself of what's out there, and not just what the mainstream narrative is, but somebody who actually looks under the hood, like Santa said, hey, maybe you should look here. And it's not contrarian. It's that the work is done and it escapes what the headline, I've never lived in the headlines in my life and it's not that I'm a contrarian, but I need to know. As I say, I'm a fourth boy in line. So my whole life has been seen through the eyes of an outlier, because I always had to, what doesn't make sense here? So it's never seen. I could see Sam goes the same way. So I'm very respectful of that. And I will certainly be reading more and following more, because I've enjoyed this.
Yes. Thank you so much, Sam. And Ira?
This has been great. Thanks for having me on. It's been a pleasure.
Thanks. This is really good. Really enjoyed it. If I'm in Boston, I'm going to look you up. It's been a while since I've been.
Yeah. No, if you're in town, definitely give me a shout.
Yeah, we'll go to Red Sox game. I know.
Yeah.
Exactly.
Okay.
All right. Thank you.
Take care. Yeah. Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.